Welcome to Chapter 10 of Fundamentals of Financial Accounting. Before we proceed with this set of notes, please make sure you have downloaded a blank file from SFU Canvas. Property, plant, and equipment, or PPE, are commonly known as capital assets. They are identifiable, tangible assets which tend to be costly, long-lasting, and can often be sold or traded in. As discussed earlier, PPE, capital assets, with the exception of land, are amortized over time until they are worn out or disposed. We also have intangible assets, such as goodwill. These are assets which have no physical form, but provide current and/or future benefits to the business. Some examples would be a strong base of customers the firm regularly sells to, copyrights on valuable products or services, and long-term contractual agreements. This table here gives us a good summary of how we treat different things. So building machinery, equipment, furniture, and pictures, they're amortized or undergo depreciation, depending on which word you like. Land, we do not amortize or depreciate. Land improvements, amortization, depreciation. Natural resources, same thing. Intangible asset, we amortize them. And goodwill, the special one, this undergoes an impairment loss if it is indeed impaired. If it's not impaired, we leave it as is. Recall that the cost principle states that an asset should be recorded at its cost on the books. More specifically, the cost of an asset equals the sum of all the costs incurred to bring the asset to its intended purposes, net of all discounts. So we mentioned a little bit earlier in the course that an asset can be brought to a sale point, and you have to include the purchase price, the shipping cost, the insurance, the storage, everything that's incurred to bring that asset to a saleable condition. The same thing happens when you use assets, right? So if you might buy a machine, you bring it over. The shipping is part of the cost. Insurance is part of the cost. The storage can be part of the cost. The assembly can be part of the cost. So anything that happens with the asset, right to the point where you start using it, it's a capital cost associated with that asset. Land. The cost of land includes the following costs paid by the purchaser: the purchase price, the brokerage commission, the closing costs, so surveying, legal, registration, title, and transfer fees, any property taxes in arrears, and the cost of grading and cleaning the land, and demolition of unwanted existing development. So let me talk a little bit more about these last two here. First, property taxes. The idea is if the previous owner owes taxes on the property, you will have purchased it from him or her at a discount. So let's say we have a $300,000 property and it has $15,000 worth of property taxes owing on it. The theory is it will sell for $285,000 net of taxes. So the property taxes in arrears are tied to the cost of the land. And the last point, this goes back to intended use of land. So if you're buying land with established fixtures on it, like say a building or even flowers or trees, if your intended use is to clear the land and put something else on it, all the demolition and clearing of the land is considered to be part of the cost of land. So let's jump into a quick example here. Juliana purchases 1 acre of land for $200,000 for a new business, a coffee shop. She also pays 4% in brokerage commission and $4,000 in transfer taxes. After the purchase is completed, she will pay $2,000 to clear the land, a $1,000 survey fee, and $2,000 for new advertising sign. What will be the book value of the land? So this is pretty straightforward. I've kind of guided you through this question. Take a minute here and work on it. We will continue here in the same video. So first and foremost, we will have a $200,000 purchase price. Then we will add on all the things we are able to as cost of land. So we have 8,000 for brokerage commission, 4,000 for transfer taxes, 2,000 for land clearing, and 1,000 survey fee. All those costs add up to 15,000. And when we add on the 200,000, we get 215,000 cost of land. Juliana has capitalized the total land cost, meaning she will debit the asset land account for $215,000. The advertising sign is expense since it's not a necessary cost to ready the land for use. The cost of land is not amortized. So, talking a little bit more about the advertising sign, it's something that doesn't last forever. So, you might have a good sign for 10 years, maybe even 20 years, maybe 30 years. But over time, it won't be as good as it used to be when it was new. With land, the assumption is that it will be useful forever. So we don't amortize land. That's why the advertising sign doesn't belong in land. What it is a land improvement. Land and land improvements are kept separate because unlike land improvements are amortized. Some common examples of land improvements are lighting, paving, landscaping, signs, fences, and sprinkler system. All of these things don't work forever. They do get worn down over time. Land improvement, like many other items in accounting, requires a certain level of professional judgment. Sometimes trees and other plants are better classified as land if they're not expected to decline in value and don't need to be amortized. This is an instance of accountants being required to use their best judgment since there aren't clear rules. Assuming Juliana spent $3,000 on plants expected to last 5 years, in addition to a $2,000 sign on July 1st, the journal entry for the cash expense is. So the big hint here is 5 years. It's not a long period of time, say like a tree, which might last a whole lifetime or longer. Because it's a short-term thing, we're going to treat it as land improvement. So we're going to bundle up the sign and the plant into one account called land improvement. So let's go ahead and make the journal entry. July 1st, improvements. The M looks a little bit awkward. A little bit better, not the best. So that will be 5,000, 2,000 plus 3,000, and then we will pay with cash. So moving on to a different kind of plant. This is like a factory plant. Buildings. So the P and E. Second P is for plant, but not necessarily a green plant, more like a factory plant. Plant refers to buildings a company owns, such as manufacturing facilities, factories, and offices. The cost of constructing a building includes architectural fees, contractors' charges, building permits, and payments for material, labor, and overhead. Equipment. There are different types of assets which fall under this category. Machinery and equipment. This category is made up of productive assets built or acquired by a company to produce, store, manage, or distribute products. The cost of machinery and equipment includes purchase price less discounts, transportation charges, insurance while in transit, PST, tax, installation cost, purchase commission, and the cost of testing the asset before using it. The GST or HST paid in the purchase of an asset is recoverable, is refunded to the purchaser, so it is not included in the cost of the asset. After an asset is set up, tested, and ready to be used, the costs, such as insurance, maintenance, and taxes, stop being capitalized and are expensed instead. Furniture and pictures. This category includes desks, chairs, filing cabinets, and display racks. As with the last category, the cost of furniture and picture assets include the purchase price, less any discount, plus all the necessary costs to ready the asset for use. Again, GST or HST is recoverable. Computers. This category can either be a standalone asset class, if there are many computers, or it can be part of one of the other groups. So if you have one or two computers in your office space, don't bother making a separate category. You can include it in equipment. But if you have full computer labs, you probably want to do a little better than that. Have it as its own asset class. Construction in progress and capital leases. Construction in progress is reserved for buildings being constructed for company future use. Construction costs are considered to be assets and not expenses, since the building is expected to provide future benefit to the company. Capital leases. A capital lease arrangement is an arrangement where a capital asset is bought by making regular periodic payments as dictated by the lease contract. These assets are shown on a company balance sheet the same way as fully owned assets. A capital lease should not be confused with an operating lease, where the leasing company does not gain ownership of the asset over time. Under operating leases, the periodic payments are shown as lease or rent expenses on the income statement. So the idea here is capital lease, you kind of show it as if you own the asset, both equity of the asset, also the debt on the asset. With operating lease, it's shown as if you don't own the asset. It's just an expense. Lump sum purchase of assets. Imagine if Krista bought Juliana's business for $450,000 cash after an unfortunate fire destroyed all the plants, trees, and other land improvements. The only assets sold to Krista were land with a book value of $215,000 and the building used for a coffee shop with a book value of $200,000. How is Krista's purchase accounted for? So the way we do this is we divide up the purchase price between the two assets using a relative fair value method. So the first step when using this method is you have to consult an appraiser. An appraisal is an expert assessment of the value of an asset. The appraisal of individual assets is not dependent on the purchase price of the transaction or the asset's current book value. Instead, the appraiser determines the value of each asset, known as the market price, independently, which allows the accountant to perform the next steps in updating the asset book values. Let's assume the appraiser valued Krista's new land at $260,000 and the building at $240,000. Note that these numbers will add up to $500,000, which is not the purchase price. Hence, adjustment must be made to make a balance journal entry to record the transaction. So we're going to do this by taking each asset as a percentage of the total appraised value of the asset sold. So I'm going to end the video here. Have a look at this table and the journal entry below, and we will start off the next video by going over these two things.